I'm Brendan McKenna, and I'm one of the international economists with Wells Fargo. And I'm joined today with Jay Bryson, our chief global economist, to discuss the most recent economic outlook. So, Jay, we recently released our economic outlook for the month of June, and some changes were made to the U.S. GDP forecast. Can you just walk through some of those changes that were made, and then what sorts of dynamics that you're seeing unfold within the U.S. economy?
Sure. So, Brendan, we bumped up our GDP forecast a tad for 2021. Now, we had a very, very strong growth rate already. And if you look at the first quarter, the economy grew over 6% annualized. And now that the economy is really starting to open back up, we think we're looking at a 10% growth rate here in the second quarter. Now, that's not sustainable. We won't continue to grow that way. But, if you look at our 2021 total, I mean, we're looking for 7% this year, which if it happens would be the strongest rate of growth since at least the mid 1980s. And then next year, we think that momentum carries in as well. Next year, we're looking over 5% growth rate. So, we think the next 2 years here in the United States economy actually ought to be pretty strong, as the economy bounces back from its pandemic-induced coma.
Great. So, you mentioned an upward revision to the GDP forecast, and that the U.S. economy is really starting to grow at the fastest pace in years. Can you touch a little bit about what that means for inflation and what you're seeing as far as your inflation forecast for this year and maybe also next year as well?
Right. So what we're seeing right now is higher rates of inflation. Both April and May, the consumer price index came in much stronger than expected. And essentially is what's happening here is, there's two things. One, if you look on the demand side, people got these stimulus checks and, there's been other sorts of relief out there. And so there's just a lot of money sloshing around in the system right now. And that's caused demand to be very strong. On the other hand, if you look at supply, there's been number of supply constraints. I mean, think about automobiles, the chip shortage there. Many auto producers have had to shut down production, and that's caused prices of automobiles to kind of skyrocket here. And it's not just those areas. There's some other areas as well where we're seeing higher inflationary pressures. So we think this year we're looking at a rate of inflation that's going to be 4% or so. That's the highest we've seen in a number of years. And the question is this going to continue going forward? And we think we'll see some moderation in inflation next year. As these supply shortages come to an end, as that demand starts to cool off, that will cause price pressures to kind of ratchet back down. So we don't think this is a major inflationary outbreak like we saw in the 1970s, where the inflation rate just kept ratcheting higher and higher year after year. But that said, inflation of 4% or so this year is the highest people have seen in quite some time. And so it will be higher this year, but we also, again, expect it to come back down next year.
Excellent. So you mentioned upward revisions to growth, inflation reaching 4% this year, supply and demand dynamics that are also pushing inflation higher. Can you talk a little bit about what that means for monetary policy in the U.S.? And is this something that the Fed is going to respond to in the near future?
No, Brandon, we don't actually think the Fed is going to respond to it. They seem perfectly happy to sit on their hands right now. The way the people at the Fed are looking at it, they also believe this is largely transitory right now, and they're willing to let the inflation rate rise right now. And the last thing they want to do is prematurely start to tighten policy here and risk putting the economy back into recession. So, we think that they are on hold through the rest of this year. We actually think they're on hold in terms of interest rates through the end of next year. Now, they may start scaling back the number of bonds that they're purchasing, the so-called quantitative easing. And when that happens, that could cause long-term interest rates to rise somewhat. But, again, largely we think the Fed is going to sit here, just watch the inflation play out, and not start to raise rates. But obviously, if this is the beginning of the 1970s, which we don't think it is, then the Fed will respond to that. But for the time being, they're perfectly willing just to be patient here. So, Brendan, let's switch gears here now and talk a little bit about the rest of the world. We talked about a very strong U.S. economy. What are you looking at globally? What's our global GDP forecast?
Thanks, Jay. We're still pretty optimistic on the outlook for the global economy. We feel like the global economic recovery is still intact, and we feel like we're going to experience an uninterrupted global economic recovery over the second half of this year and as we push into 2022 as well. So as far as our forecast, we're forecasting the global economy to expand a little over 6% this year, That'll mark the fastest pace of economic growth for the global economy in decades. And as you mentioned, Jay, the United States seems to certainly be leading the global economic recovery. But we're starting to see signs that some of the growth prospects for some of these international economies, particularly within the G10 and the advanced economies, some of those growth prospects are starting to improve. We're starting to see some signs that the economic recovery may be a little bit stronger than we initially expected. And to that point, we've made some upward revisions across countries within the G10 space. So we're looking for advanced economies to grow around 5.5% this year. Again, that's an upward revision from some of our prior forecasts. And then we're also looking for the emerging markets as a whole to grow a little under 7%. So a pretty optimistic view on the global economy. Again, we're looking for global economic growth in the 6% range, which would mark the fastest growth that we've seen in decades.
So that recovery that you're talking about, is that broad-based? Is there a difference between, say, some of the major economies in the world versus some of the developing economies?
Absolutely. So we're definitely starting to see some divergences in growth prospects between the developed market economies and then the emerging markets. And by far, the developed market economies are certainly leading the global economic recovery. We spoke about the United States and the outperformance of the U.S. economy. But the growth prospects for the Eurozone are also starting to improve. And that's really on the back of a stronger pace of vaccinations. It also looks like we're going to get some fiscal stimulus towards the end of the summer. So the growth outlook for the Eurozone is also starting to improve as well. And we could also say the same for some of the commodity-linked currencies within the G10. So there we're talking about Australia, New Zealand, Canada, where higher commodity prices and not as much of a COVID issue is helping the local economic recoveries in those countries as well. But on the EM side, a lot of the emerging market economies are lagging the G10 as far as recovering from the pandemic. India is certainly an example where another wave of COVID cases and pretty harsh lockdowns and restrictions are going to weigh on the economic recovery. So we've actually taken another look at our GDP forecast for India and revised our outlook lower. So we're now forecasting about 10% growth this calendar year for India. That's down from almost 11.5% growth to start the year. So maybe some of the optimism that we're seeing in the G10 not exactly starting to spill over into the emerging markets quite yet.
Okay, and what does all this mean for the value of the dollar? Is the dollar going to strengthen versus currencies, or do you think it's going to weaken?
We think there's a couple of dynamics that are going to play out as far as why we expect the US dollar to weaken. The first is the improving economic growth prospects in some of these international economies, especially within the G10. I mentioned the Eurozone, the UK, Australia, these types of countries that are seeing their growth prospects starting to improve. So we think that should help boost sentiment towards foreign currencies. And then on the other hand, as you mentioned, Jay, we think the Fed is going to stay pretty dovish and keep monetary policy as accommodative as possible for at least the foreseeable future. And we're already starting to see G10 central banks like the Bank of Canada, the Bank of England, already start to taper asset purchases, and then the Reserve Bank of Australia starting to turn a little bit less dovish as well. So as these central banks internationally start to normalize monetary policy a little bit quicker than the Fed, we think that's ultimately something that can support foreign currencies going forward.
Okay, great. Well, thanks, Brendan, for that. And thank you all for joining us today for our monthly economic outlook video. This story has evolved over the last 15 or 16 months, and it'll continue to evolve as the global economy bounces back from the pandemic. And as our thoughts continue to evolve, we will keep you up to date. So again, thank you for joining us today.